Let's talk about anti-crime regulation. And this is a type of regulation that focuses on preventing both the storage of illicit funds in the bank or the transmission of those funds using that bank. There are usually 4 pillars of compliance for this area, and there are usually also 3 main areas within it: know your customer, anti-money laundering, and the counter-financing of terrorism. Let's take a look at each of these in more detail. The Banking Secrecy Act, or BSA, of 1970 in the United States defined multiple guidelines that have evolved over time, specifically in terms of banks taking measures to prevent money laundering and or to prevent the passing of illegal funds through the system. And by the way, I know that the name may sound misleading. Bank Secrecy Act. It's almost like it's promoting bank secrecy, but it's the opposite, okay? You should read it as the Against Banking Secrecy Act. We are trying to fight secrecy in illicit transactions. There are 3 major areas of anti-crime regulation that started with the Bank Secrecy Act and have evolved over time. The first is KYC, or Know Your Customer. It's a set of measures for a bank to verify the identity of their account holders. Photos, fingerprints, identity documents, whatever it is. Because if you prevent anonymous accounts or fake accounts, you prevent a lot of wrongdoing down the line. The second type is AML, or anti-money laundering. These are transaction procedures to prevent the entering of laundered money into the system. That is, preventing illicit funds from being placed in a bank in the first place. And these include, for example, hold periods for transactions or the reporting of suspicious actions through SARs or suspicious activity reports or high amounts of currency, reports known as CTRs or currency transaction reports. And finally, we have CFT, or the counter-financing of terrorism. This takes anti-money laundering one step further, and it analyzes transaction flows to identify sources of terrorism financing. We'll take a look at the differences in the next slides, but AML cares about the source of funds, while the counter-financing of terrorism cares about the destination of them. Let's start with KYC. Know Your Customer verification consists of a set of measures to verify the identity of an account holder. It may be done manually by the bank staff, verifying documents, or through automated solutions. It can include, among other elements, facial recognition, for example, to match a person to a photo, verification of the identity document itself, address verification, utility bills, rent contracts, or others, or even biometric verification if possible, fingerprints, retinal scans, or others, although these are more expensive. So KYC is just part of a broader process called CDD, or Customer Due Diligence. Know Your Customer cares about the identity of the customer in specific, while Customer Due Diligence includes all types of due diligence done on a customer. We also have eKYC, or Electronic Know Your Customer, and this is the name given to electronic platforms that perform KYC in an automated manner. These include automated facial recognition based on a photo, for example, or using OCR to detect characters and identify the text in identity documents, and so on. Adoption of these tools has been accelerated with the trends towards digital banking, but also the COVID-19 pandemic, naturally. In terms of AML and CFT, the first thing to note is that these are both related. While vanilla anti-money laundering measures are used to detect and to prevent money laundering by preventing illicit funds from entering the system, CFT goes one step further and tries to identify patterns in transactions that may be used for terrorism financing, that is, the destination of the funds. AML measures, in a general sense, can include identity verification, and there is an overlap with Know Your Customer here, as well as detecting the person's possible status as a politically exposed person or not. So a PP, or politically exposed person, is someone, such as a politician or military leader, that just due to their position is more exposed to bribery, fraud, and others, and identifying a person as one should immediately trigger additional diligence. Also, verification of the person's presence in international sanction lists. That is, does my country forbid me from transacting with this person, or even anyone from this country? Then, actual transaction monitoring, which is the bulk of AML and CFT, and it may include specific measures such as, first, detecting unexpected transactions, suddenly high values, or a suddenly high volume. For example, if you receive $10,000 per month on average, it would be weird for you to receive 10 million instead of 10,000. Or it would be weird for you to receive 100 transactions of 10,000 instead of just one. Or, for example, transactions with a high-risk person, a sanctioned person, or a politically exposed person. And finally, extensive documentation of suspicious activity is also important for possible future compliance with legal investigations. Since you never know whether this person is guilty or not, you have to store all data on suspicious transactions so that if later law enforcement brings an action, you can retroactively fetch information on that person. It's important to note that a major component of AML and CFT is the filing of two types of reports. These reports facilitate cooperation with legal enforcement agencies later, and these are CTRs and SARs. CTRs are currency transaction reports. They are reports for any transaction above $10,000, period, regardless of nature, individual, or bank. It's important to note here that these are not just for individual transactions. If the bank thinks that it's justified, it can aggregate multiple transactions that cross this threshold if they are by the same person. For example, someone first transfers 3,000, then 4,000, then another 3,000 to make up those 10,000. And that's possibly to actually try to avoid a CTR. And it's a practice known as structuring. Instead of transacting it in one go, they split it to try and avoid the reports. So the bank can identify these and aggregate them. The second type are suspicious activity reports, or SARs. These are reports for any activity that is suspected of violating the law. They can include deposits, withdrawals, transfers, ATM transactions, and any other action by a suspicious person or with an unusual pattern. For example, a politician receiving 10 million in their account the day that they are elected, or someone depositing $100,000 when they have never deposited anything in that area, or if that area is known for drug trafficking, among other patterns. In our previous example, if the bank detects the structuring of a transaction to avoid a CTR, that's an immediate SAR as well, because there's probably a reason why they were trying to avoid that report. In the US, regulatory agencies consider that there are 4 pillars of compliance in AML and CFT risk management. These are considered the minimum compliance requirements, and they expect every bank to have these 4. First, internal controls for ongoing compliance. That is, there must be processes for reports, for flagging suspicious activity, and so on. Then, there must be independent auditing of AML and CFT compliance. Naturally, this is similar to the independent auditing of other risk management and compliance functions in a financial institution. In any healthy organization, there must be risk management, compliance, and independent auditing. Each one is an independent function with their own authority. So AML and CFT are no exception. The third point is the existence of an owner for the compliance function. That is, a specific person or a specific group who is responsible for AML and CFT. Making someone responsible gives regulators leverage over the institution, and it will make that person incentivized to make this area of compliance work effectively. And finally, proper training of employees in AML and CFT matters is a must. That is, proper filing of reports, proper customer due diligence processes, and more. People must be formally trained to perform these actions. And finally, it's important to note that AML and CFT regulation is one of the areas that presents the highest challenges, because in a way, it's useless for banks. And this is due to two very specific conflicts, in terms of revenue and in terms of nationality. So first, there's a conflict in terms of revenue. Plain and simple, many possibly suspicious individuals are usually private banking clients, which generate hefty fees for the bank. So naturally, many bankers don't want to risk their bonuses by asking uncomfortable questions. In certain cultures, even asking the question can be considered an offense, and it can lead to losing the client. So private bankers are walking a very strict tightrope. Then there's a conflict in terms of nationality. That is, in many cases, financial crime is international and it's cross-border, yet the bank must obey this regulation locally. In short, a local bank is trying to contribute to a situation that doesn't really benefit their country in specific, so there's not a lot of patriotism or loyalty in this case. These two usually make AML and CFT areas where banks don't really want to help unless they have to, and they mostly do it just to avoid the consequences of not complying. What are some examples here? The first is publicity and exposure. By this I mean, although the most direct ways to identify money laundering are someone being present in a list of known offenders, naturally, or being a politically exposed person, or a sanctioned person, it's important to note that just public associations and negative publicity also help. If you're a politician with a completely clean record, but suddenly there is bad publicity about you being associated with criminals, and you receive the transfer of a higher value than normal, that is immediately reported. Then, know your customer is continuous. The verification of a client's identity in terms of KYC should not just be done at the beginning when they create an account, but every few years to keep the records updated, or at least it should be in a good bank. This is because there may be cases of identity theft, where an attacker steals an identity, but they can't update the documents later on because they're not the person. In these cases, they're not caught by KYC when creating the account, but they will be caught later. And finally, money laundering detection techniques have a lot in common with fraud detection ones. In technical terms, they include techniques in terms of IT, such as velocity checks, that is, how fast the money flows, or how fast the different recipients of the transactions change, or others such as hotlists, information verification, and more. What are our key takeaways here? The first is the BSA, or Bank Secrecy Act of 1970. It had the goal of shedding light on secret transactions of illicit money, and it introduced three main areas of anti-crime compliance, which evolved to be in the present: know your customer, anti-money laundering, and counter-financing of terrorism. Know your customer, in specific, is the practice of verifying your customer's identity to make sure that anonymous or false identities are not being used to store capital or to transfer it. Then, anti-money laundering, including the counter-financing of terrorism, includes detecting suspicious or irregular transactions and documenting these to cooperate with the authorities. Then, there are two main types of important reports: currency transaction reports, or CTRs, for all transactions above 10,000, and suspicious activity reports, or SARs, for any type of activity that is considered suspicious. Then, there are four key pillars of compliance in terms of AML and CFT, and United States regulators demand these four pillars as a minimum. Number 1, internal controls. Number 2, independent auditing. Number 3, an owner for this function. And number 4, proper employee training. And finally, there are two core conflicts at the heart of AML and CFT compliance. One is a financial one, which is a tension between profiting from private clients and doing diligence on them, and the other is in terms of nationality, trying to solve an international problem with local compliance. Both are a cost-benefit calculation. So as we see, we have three main areas within anti-crime compliance. Know your customer is all about customer diligence, knowing who has an account. Anti-money laundering is all about preventing illicit money from entering the system. And the counter-financing of terrorism is all about preventing money from flowing to actual terrorists. There are also four main pillars of compliance in this area: internal controls, independent auditing, having an owner, and proper employee training.